Welcome to The Explainer. Today, we're cutting through all the social media hype and running the actual, unvarnished 20-year math on the ultimate financial heavyweight debate, real estate versus index funds. We're not picking a winner here. We're just going to let the numbers speak for themselves. Let's just jump right in and meet two 30-year-old neighbors, Jake and Marcus. Now, they live in the exact same city, and they're staring at the exact same financial starting line. But they're about to make two very different choices that will literally dictate the next 2 decades of their lives. Here's the setup. Both of these guys earn exactly $55,000 a year, and both have scraped together exactly 50 grand in savings. Now, Jake takes his 50 grand and uses it as a 20% down payment on a solid $250,000 3-bedroom rental property. It feels real, right? It's tangible, and it sounds super impressive at dinner parties. Marcus? Well, Marcus takes his 50 grand and quietly dumps it into a total stock market index fund. It's a choice that generates exactly 0 exciting stories and just leaves his coworkers politely nodding before they change the subject. So, on day 1, Jake is feeling like an absolute genius. He immediately finds a tenant, locks in an $1,800 monthly rent, and against his $1,330 mortgage, that gives him what looks like a brilliant $470 in monthly cash flow. You know the number. That's the exact figure you see plastered on a thumbnail claiming real estate is the fast track to wealth. And honestly, this perfectly illustrates the massive psychological divide between these two strategies. Jake's investment is right there. It's physical. He can literally drive past that 3-bedroom house on his way to work and think, yeah, I own that. He gets those social rewards when he talks about his properties at a barbecue. Marcus, on the other hand, just has an abstract, invisible confirmation email. His choice is, well, incredibly boring. All right, moving into Section 1, Year 3, the spreadsheet reality. This is where the whole landlord fantasy abruptly collides with brutal spreadsheet math. On paper, Jake has collected over 60 grand in gross rent over 36 months. To all his friends, it looks like he's netted almost 17 grand, $16,920 to be exact, in pure cash flow. Again, it sounds like an overnight gold mine. But when we actually open up the spreadsheet and subtract the invisible costs that everyone loves to bury in the footnotes, a completely different story emerges. Over those 3 years, Jake had to fork over roughly $9,000 in property taxes, $4,500 for insurance, $1,200 for a blown-out water heater, another $2,800 for a surprise roof leak, and then he had to swallow $1,800 in lost rent from a month of vacancy, plus a $600 fee just to relist the place. Ouch. And because Jake's managing this property himself to save a few bucks, he's basically working an unpaid part-time job during his lunch breaks and weekends. He's taking late-night phone calls for free. After every single real-world cost is paid, his actual net cash flow over 3 years isn't 17 grand. It's a meager $2,000 to $4,000. Meanwhile, Marcus has spent 0 hours managing his money, 0 nights losing sleep over a tenant. Assuming a 10% average historical return, his account has passively grown to roughly $76,000. But don't count Jake out just yet. He holds one massive advantage that Marcus does not have: 5-to-1 leverage. This means Jake's initial 50 grand controls a $250,000 asset. So even with a modest 3 to 4% annual appreciation on the home, that leveraged growth has pushed his equity to nearly $65,000. Leverage is hands down the most powerful tool in real estate, and it's exactly why Jake feels like he's winning. But, leverage is a double-edged sword. It requires constant maintenance and a seriously high tolerance for risk. Okay, let's jump to Section 2, Year 10, the Great Equalizer. This is where we see the gap between the two strategies begin to narrow in a way that honestly surprises most people. Fast forward to Year 10, Jake's property has appreciated beautifully, pushing his equity up toward $184,000. But Marcus is right on his heels, sitting at up to 180 grand. How? Through the sheer, quiet power of compound interest. He is literally making gains on his gains. That compounding curve is now generating way more new wealth each year than Marcus's original monthly contributions ever did. Now, the math shows us something fascinating here. While they're incredibly close in total wealth, their lifestyles and risk profiles are completely opposite. Jake has spent hundreds of hours dealing with tenant turnovers and replacing an $8,500 roof. He's hyper-concentrated in a single asset in a single zip code, carrying nearly $200,000 in debt, and frankly, mourning his lost weekends. Marcus? He's globally diversified across thousands of companies, carries 0 debt, and has absolutely 0 stress. Let's look at Section 3, Year 20, the final score. This is the moment the unvarnished math finally settles the debate once and for all. After 2 full decades of plumbing emergencies, tenant screening, and property taxes for Jake, and 2 decades of doing absolutely nothing for Marcus, both men land in the exact same wealth bracket. They are both sitting on roughly $400,000 to $500,000 in wealth. Unbelievable, right? Just look at the breakdown of Marcus's invisible wealth. Over 20 years, he only ever contributed $122,000 out of his own pocket. That means over $300,000 of his net worth is pure passive compounding. He didn't try to pick winning stocks. He didn't try to time the market. He just left the math do the heavy lifting for him. So the crucial takeaway from this 2-decade financial race really boils down to this fundamental difference. Jake worked for his wealth, while Marcus simply waited for his. They're both genuinely wealthy now, but the toll it took on their lives to get there couldn't have been more vastly different. Looking at this timeline perfectly visualizes Marcus's journey, and it proves why the index fund strategy is so incredibly effective. It requires absolutely zero extra time, effort, or late-night phone calls. Year 1, he set up autopay. Year 3, did nothing. Year 10, still doing nothing. And by year 20, he generated over $420,000. And here's where the math gets genuinely staggering. If Marcus had just bumped up his monthly contribution by a measly $200, taking it from $300 to $500 a month, his 20-year portfolio would jump to nearly $600,000. To scale his wealth like that, Jake would literally have to go out, buy a second property, take on another massive mortgage, and double his weekend workload overnight. All right, Section 4, the honest truth about both. Now, to remain completely impartial and honest here, we have to flip the coin. If we only bashed real estate, we'd be doing exactly what every stock market influencer does online. We absolutely need to look at the brutal downsides of Marcus's strategy too. The stock market is gut-wrenching. It's characterized by massive, terrifying volatility. In 2008, the market dropped 37%. In March of 2020, it plummeted 34% in a single month. This kind of panic causes average retail investors to sell, locking in their losses at the absolute worst possible moment. Plus, index funds offer practically zero cash flow. You're looking at a tiny 1.5% to 2% yield. You have zero leverage. Your 50 grand only controls 50 grand of assets. And you get absolutely none of the depreciation tax shelters that real estate investors get to enjoy. Conversely, real estate is not a bad investment at all. It's just a highly specific investment that wins heavily if you meet certain conditions. It wins if you have that local market knowledge and find a property where the monthly rent is 0.8% to 1% of the purchase price. It wins if you treat it like a serious business with proper systems. It wins if you house hack by living in one unit and renting out the others. And it absolutely wins if you aggressively utilize tax codes like 1031 exchanges to defer capital gains. So the most important question you can ask about any financial investment isn't which one wins on average. Honestly, that's the wrong question entirely. The right question you need to ask yourself is, did I honestly include all the invisible costs, the real-world risks, and the heavy time commitments? Because the answer that includes everything is the only answer that actually matters for your financial future. As we wrap up this explainer, I'm going to leave you with this final provocative thought to chew on. When you look at the unvarnished math, over 20 years, the choice isn't really about returns at all. The real question is this. Are you looking for a second part-time job that builds highly tangible, heavily leveraged wealth? Or are you looking for invisible, abstract freedom?